If you're currently thinking about living the passive income dream where all of your bills get paid by dividends, you might want to just think again before you go all in, because there's some major problems that you need to know about first. I've got 5 key points to go through in this video that are essential for investors to understand, and they could be the difference when spending a retirement like this,
I'm rich,
or something like this.
I've got nothing left.
Gotta love that meme. Anyway, the first key point is this: dividends are not guaranteed in any way, shape or form. Dividend is paid out from a company, usually from their profits, and you might get one once a year or once every 3 months. In good times, this is all nice and straightforward. The business is going great and the company has so much money that they can just give it back to you as a shareholder. The more shares you own, the bigger your dividend payment is. You'll see some cash go into your investing account, and this is about as close to true passive income as it gets. The issue is that with investing, the bad times will always come when you least expect it, and one of the first things to go is that lovely dividend payment. If you have a look back through history, you'll see countless stories of big successful companies cutting or even completely stopping their dividend payments. One I've mentioned before in a previous video is from the big US giant General Electric. They reduced their dividend payment after 119 years to just a penny a share. Now, what this shows is that even the strongest companies with the greatest records of paying a reliable, consistent dividend can stop at any point. And this isn't just a US thing. Plenty of companies based here in the UK have faced similar problems in the past, and you're only going to go back to around 2020 to see when that happened. Now, I'd hope that most people know that this is always a risk anyway. The point I wanted to raise was that if you were to rely on dividends as an investor, you could run into some issues. Imagine you've got a nice budget together with all of your costs and bills, and you've got your income from dividends. Well, what happens when your dividends get cut in half for whatever reason? Your bills don't suddenly go the other way, so that leaves you with a big issue. You can either pull on some other savings you might have, take on some debt, or I guess you could also sell some of your stocks to cover the difference. Either way, your bills stay the same or keep getting more expensive, but your dividends can quite easily get cut a couple of times or even forever. Just remember that if you do sell those stocks, that will also hurt your dividend payments the next time round as well. So you could end up in a bit of a spiral that ends you with nothing left.
I've got nothing left.
I think that meme has still got plenty of legs in it for this video. Now, this leads us on to the next point quite nicely. Every time you get paid a dividend, it's what's called a taxable event. That's just a fancy way of saying you've received some money and that money could be liable for taxes whether you like it or not. Now, this all depends on your own financial situation. But the point I wanted to highlight was that whether you need the money or not, a dividend gets paid. And sure, you might put it to one side, you might reinvest it, or you might go ahead and spend the money. But either way, you've now got a potential headache to worry about. For example, getting a dividend could push your income into a new tax band, and therefore you might end up having to pay a greater amount of tax. Also, depending on the kind of investing platform you use or the kind of account, reinvesting that dividend money could take you some time or even just cost you a bit in trading fees. All of these things add up, and even if some things don't cost you money, they do cost you time, and this is the most valuable thing that we all have. Now sure, on that note about the right kind of investing account, if you do use something like a stocks and shares ISA here in the UK, there's no dividend tax or capital gains tax to pay, which is amazing. And I always say that it's so important to make sure that you make the most of whatever way you choose to invest. I always keep the links below in the description to the platforms that I use, and you can get yourself some free cash or free shares to get yourself started. So don't forget to check those out once you finish with the video. Just as a quick example, let's say that you did invest outside of a tax-free account. Your dividend payments could end up costing you quite a bit of money that you weren't expecting. As a basic rate income taxpayer in the UK, any dividends you earn above £1,000 this tax year, which is dropping to just £500 next tax year, will leave you with a tax bill to pay. And the dividend tax rates currently look like this. So you can see that you'd be liable to pay 8.75% of your dividends to the taxman, regardless of whether you spend them, reinvest them, or just leave them in your account. As always with investing, any fees, charges and costs should be kept to a minimum, as this is one of the only things that you can control. Anyway, just a thought. Now this next point is really important and gets to the heart of the issue for me. If you want to retire using dividends and get a really nice passive income, you're going to need a solid investing portfolio that can last you a few decades. Let's say that you're in your late 50s or early 60s and you want to start taking those dividends as income that you've worked so hard to build up. Over the next few years and even decades, you want to make sure that you don't suddenly have nothing left. Don't do it. Don't do it. Don't play the video.
I've got nothing left.
Sorry. Anyway, you need to cover all of your living costs and also allow for inflation too, so that every year, as things get more expensive, you see your income rising up. Now, a lot of companies that do pay a dividend will increase their dividend every year, and this might make up for the rising cost that you could see with inflation. However, there's absolutely no guarantee that this happens, and like I said at the beginning, a company does not have to pay a dividend or increase its dividend either. Now, you could say that you only invest in companies with a long track record of paying dividends, so therefore there's nothing to worry about and you'll be just fine. But we have no idea what will happen in the next 20 years, let alone the next week. So how do we know if we're making the right investments to keep those dividends going? Here's where I'd say, well, we have no idea. If the companies you invest in don't grow both their dividends and their share price, then you could end up slowly eating away all of your investments without realizing it. For example, a company might pay out 5% of the share price as a dividend, and you'll see that in your account and think, that's great. But then over a period of time, say 5 years, you check the company's share price and see that it's down 15% or maybe worse. So while you were still getting a dividend and assumed everything was looking good, the company was getting worse, and they may have even been pressured to keep paying that dividend just to keep people happy. Now, here's where the idea of total returns come in. If you're an investor who wants to use dividends to retire and not touch the rest of your shares by selling them, you still have to pay attention to the total return of your investments. The total return is what you get when you combine the price of the stock and the amount of dividends that we're paid. Here's a quick example. Imagine you have a company with a share price of $10 today, and in 5 years, the price of the stock is $12. Over those 5 years, the company also paid annual dividends of $1 each. So therefore, you received $5 in dividends in total. Overall, this means that the stock had a total return of $7. $2 was from the price going up, and $5 was from the dividend. You turned your $10 into $17 of total gains. Nice and simple math, I hope. Now, imagine a second company going from $10 to $17, but paying no dividends at all over 5 years. The total return is exactly the same. But why is this important? Well, if you don't get good total returns and just focus on your dividends, you could end up losing out in the long run. Remember, if you want to retire on those dividends, you'll need them to last for decades. So you want to keep them as sustainable as possible. Lots of companies that pay out a dividend today tend to be the companies that are growing a lot slower and are already way past their peak. And by owning these companies, you might be missing out on a huge amount of potential. Let me show you something quickly here as an example on this point. I've got 2 investments here on this chart showing the total returns of some of the best dividend stocks in the world versus the S&P 500. This goes back as far as I can for this particular investment, and it's an ETF called NOBL. It contains the Dividend Aristocrats, which are a collection of stocks that have paid dividends for 25 years or more and often grown them along the way. When you put this against something like the S&P 500, what you notice is that the dividend stocks have underperformed the market by quite a long way. Now, yes, there were times when they were very close and there wasn't much between them, but the most recent swings toward the big stocks have left the dividend payers behind. How will this continue in the future? I have no idea. But I will say that if you only choose stocks that pay a dividend, you will miss out on a huge part of the rest of the market. For some more perspective, I always enjoy this part. Let me show you something interesting here. If I ask this platform how many stocks have beaten the returns of the S&P 500 over the last 10 years that also pay a nice dividend of, let's say, 4%, the number is extremely small. Out of all the stocks in the US, Canada and Europe, which is around 22,000 right now, just 1,216 have matched the current 10-year average gain of the S&P 500 in terms of total return, which for reference is a whopping 15% a year. Now, of those 1,216 companies, how many have also paid that dividend with a yield of 4%? The answer is just 180 companies. So I make that 0.8% of all companies. Now, I use 4% because this is often quoted as a stable rate to withdraw from your investments to ensure that your money doesn't run out. But clearly, in this case, if you're a dividend investor, all of that 4% will have to come from dividends, as you don't want to sell a single share. Pretty crazy, isn't it? So you really have to ask yourself the question, how are you going to make sure that you only invest in the less than 1% of stocks that actually do well both in dividends and in growth? I'm not sure you can honestly tell me you know the ones to pick, but I'm sure there will be people in the comments with all of the answers. Anyway, moving swiftly on, there's a major issue that I think will face dividend investors moving forward, and that is that more and more companies are choosing to buy their stock back compared to paying out a dividend like they used to in the past. You can see this happening live when you look at the dividend yield of something like the S&P 500 over the long term. Right now, it's at pretty much the lowest point it's ever been at less than 1.4% a year. So this would mean that for every £10,000 you had invested, you'd see just £140 a year come back to you as a dividend, which isn't exactly going to let anyone retire early. Now, in the past, there were loads more dividend-paying companies in the S&P 500, And it's not really a surprise when you look back at the types of businesses that used to really dominate the index. You had the big oil companies, the big communication companies, and the big utility companies all paying out healthy dividends as they were flush with cash and they had nothing else to do with the money. Today, you have a very different set of companies, mainly technology ones, who are still growing very quickly, but they pay way less dividends, if at all. And they all seem now to prefer to buy back their stock instead. Now, remember that buying stock back has the same overall effect of a dividend when you look at total returns. If you get a 5% dividend or a 5% buyback from the stock you own, the effect is the same, but obviously you don't get paid any cash from a buyback, whereas a dividend will actually see you getting something in your hands. If this trend continues to happen, which it looks to be doing in an ever-increasing pace, we might see more and more companies buying a stock back rather than pay a dividend. Now, as a dividend investor, if you are out there chasing those companies who pay a dividend, you can end up missing on a huge amount of total returns if you only invest in companies that pay a dividend. And sure, as another argument, you might say, well, Apple pays a dividend, so does Nvidia, and Meta just announced that they would pay one. But the amount they pay is very small. And let's be honest, the reason they're paying a dividend probably has a lot more to do with getting money out to some of the really big shareholders so they don't have to sell their stock. If you can retire getting just 0.5% as a dividend yield like Apple currently has, then your portfolio is so big and I have no idea why you're watching this video. Feel free to donate some of it to us mere mortals when you have a chance though. I'm not going to say no to maxing out the ISA this year. Anyway, be careful on the dividend front. You might see less and less companies paying dividends moving forward and instead buying their stock back. And I really don't think that most investors can afford to miss out on all of that growth while they stick with a shrinking set of companies. But hey, just a thought. Okay, final point before I wrap things up and give you some of my thoughts. I'm still very worried that a lot of people truly don't get how dividends work. And I know I say this a lot on my channel, but I have to say it again. A dividend is not some kind of magic-free money. As I said earlier, a dividend is a payment from a business to you. When that payment is made, the value of the company will drop by the amount of the dividend. It's moving money from the company bank account to your bank account, and no new value is being created. Now, I hear this argument a lot that during market crashes, people love the fact that their dividends are still being paid most of the time. And they feel great because they don't have to sell anything from their stocks or their principal, as they sometimes like to call it. And a lot of people also comment and say that you love dividends as they really motivate you to stay invested and challenge you to keep growing your investing going forward. And I totally get this. I also get that it must be satisfying seeing a dividend even in a market crash when everything else is crashing, but those older stocks that grow slower are still ticking along. But some people must think that this is some infinite money glitch, as they think that if they only ever use dividends and never sell their shares, it will be an income forever. Unfortunately, this could not be further from the truth, as the same rules apply to dividend stocks as other stocks in the market. In the long run, most companies end up bankrupt or sold to someone else. Very few ever make it. And you can see this if you just think about the companies that used to be the big players 10 to 20 years ago that are now no longer to be found. And remember the question I asked earlier about the future? How are you going to be the ones to pick those less than 1% of stocks that are actually worth owning? I think the likelihood is that you probably won't if you're really honest with yourself, and you could end up with nothing left.
I've got nothing left.
Sorry, last time I used that one. I promise. Alright then, solution time, or at least some of my thoughts. First off though, I'm not your financial advisor, and at the end of the day, it's up to you how you choose to invest. Truly, I don't care what you do, but I do want people to at least understand the risks before they have to make a choice and have as much information as possible. So for me, if I was looking to retire with my investments, personally, I'd sell what I needed as I need it. Not only that, but I'd look to be holding at least a couple of years worth in cash to protect me from any short-term stock market moves. If I wanted to reduce my cost in a month or increase what I spend, I want that decision to be mine and not the decision of a company board who wants to pay out money. I would also much rather just have an investment portfolio that's well diversified across all kinds of stocks that will still keep growing even as I'm taking money out, because I know that, touch wood, I'll still need to draw on this for a few decades. So to be honest, I'd still keep things mostly in low-cost index funds, probably global for me personally, but some of you might just go with the S&P 500 and be happy. I choose funds that reinvest dividends automatically, and then the choice is completely mine when I choose to sell and draw down. At the end of the day, we have no idea what the future holds, so I think that we have to remain flexible if a stock market crash comes around, and be prepared to take less in tough times if we can get through it. Anyway, that's my view, but what do you think? Please do join the conversation in the comment section below and tell me how I'm wrong, because Warren Buffett gets millions in dividends, bro. I'll see you in the next video. Happy investing.